Welcome to Clarity of Concept UPSC channel. This video is about monetary policy of RBI. You must have come across repo rate, reverse repo rate, bank rate, marginal standing facility, open market operations, moral suasion, credit rationing, and so many related terms while studying Indian economy. This video shall clear all your doubts about these topics. This is very important every year for UPSC Prelims, Mains and interview also. We did a video on banking fundamentals recently. Watch both of these videos for a proper understanding of all fundamental UPSC economic concepts. In this video, we shall discuss all concepts related to monetary policy of India. Follow our playlist for all videos on Indian economy. Monetary policy is simply how a country's central bank controls the flow of money in the economy. Every country needs monetary policy because too much money in circulation can cause prices to rise, known as inflation. Too little money, on the other hand, can slow down economic growth. In India, the Reserve Bank of India (RBI) is responsible for setting and managing monetary policy. RBI does this under the authority given to it by a law called Reserve Bank of India Act 1934. Whenever there are changes in the economy, such as rising prices or slowing growth, RBI adjusts its monetary policy. For example, if prices start rising too fast, RBI might raise interest rates. This makes borrowing more expensive, so people spend less and save more, helping control inflation. But if the economy is slow and businesses are struggling, RBI might reduce interest rates. Lower rates mean cheaper loans, encouraging people to borrow more, spend more, and boost economic growth. So, the main objective of monetary policy in India is clear: maintain stable prices and support steady economic growth, creating an environment where people and businesses can plan, invest, and grow confidently. The amount of money available in our economy directly affects inflation. Inflation simply means prices going up continuously over a period of time. If there is too much money circulating in the economy, people start spending more. Because of higher demand, prices begin to rise faster. On the other hand, if there is too little money available, spending reduces, demand drops, and prices may begin to fall. So, by controlling how much money circulates in the economy, RBI tries to manage inflation. When prices are rising very quickly, RBI uses monetary policy to reduce money supply, which helps bring prices back down. But if the economy is slowing down and businesses struggle, RBI increases the money supply. This encourages spending, boosts demand, and helps kickstart economic growth. In simple terms, RBI's monetary policy has power to influence two key things: controlling inflation and supporting economic growth. RBI has many different tools to achieve this. Some of these tools help RBI increase the money supply while others help reduce it. But ultimately, all of these tools share one common goal: to manage the supply of money in a way that balances growth and controls inflation. Before we start studying the different tools RBI uses to control the money supply, let us quickly understand who actually makes these monetary policy decisions in India. Earlier, it was just the RBI governor who had the final authority to decide monetary policy, including setting interest rates. These decisions used to be taken about once every 45 days. But having just one person decide everything had some problems, like decisions could become biased, unpredictable, or unclear. So there was a need for a more transparent and structured system. That's why in 2016, the government made an important change. It amended the Reserve Bank of India Act 1934 through the Finance Act 2016 and created the Monetary Policy Committee or MPC. Now, instead of just one person, a committee of 6 experts makes these important decisions together. This committee has 6 members. The RBI governor, who is the chairperson, a deputy governor in charge of monetary policy, one RBI officer nominated by RBI Central Board, and 3 external experts appointed by the Government of India. These external experts serve for 4 years and cannot be reappointed. The MPC has a clearly defined goal. It has to keep inflation under control. Initially, when the MPC was set up in 2016, it was given the target to maintain inflation at 4%, allowing it to fluctuate by plus or minus 2%. That means inflation should ideally remain between 2% and 6%. This target was initially set for 5 years. In 2021, the government reviewed it and extended the same inflation target for another 5 years, that is up to 2026. If the MPC cannot keep inflation within this range for 3 quarters in a row, that means for 9 continuous months, it must give a formal explanation to the government. It has to clarify why the target was not met and outline steps to correct it. The RBI Act 1934 mandates that the Monetary Policy Committee MPC must meet at least 4 times a year. However, in practice, the MPC meets 6 times annually, approximately once every 2 months. After each meeting, the MPC publicly shares its decisions along with explanations for these choices. This structured and transparent approach has enhanced the predictability and credibility of India's monetary policy. Now, let us understand the tools RBI uses to control money supply in our economy. RBI mainly has 2 types of tools: quantitative tools and qualitative tools. Quantitative tools are cash reserve ratio, statutory liquidity ratio, repo rate, reverse repo rate, open market operations, liquidity adjustment facility, marginal standing facility, and bank rate. Qualitative tools include margin requirements, consumer credit regulation, credit rationing, moral suasion, and direct action. The basic difference between these two sets of tools is simple. Quantitative tools control how much money flows into the economy. They either increase or decrease the total money supply directly. Qualitative tools, on the other hand, don't focus on the amount of money but rather on where and how this money can be used. RBI uses qualitative tools to direct credit towards certain sectors or to discourage lending in areas that could negatively affect the economy. In short, quantitative tools manage the quantity of money, while qualitative tools control the quality or direction of credit in the economy. Let us now understand each quantitative tool in more detail. The first two important quantitative tools are the cash reserve ratio CRR and the statutory liquidity ratio SLR. We have already discussed CRR and SLR very thoroughly in our previous banking video. You can watch that video if you want more details. But here, let us quickly revise them once again in a simple way. First, let us look at the cash reserve ratio CRR. CRR is simply the percentage of total deposits that banks must keep with RBI as a reserve. Let us take an example. Imagine a bank has total deposits of 100 crore rupees collected from different people. Suppose RBI sets the CRR at 4%. This means the bank has to keep 4 crore rupees from that 100 crore with RBI. Banks cannot use this money to give loans. They now have only 96 crore rupees available to lend. Let us understand clearly what happens if RBI changes the CRR. Suppose RBI increases CRR from 4% to 6%. Now, the bank must keep 6 crore rupees with RBI. This leaves bank with only 94 crore rupees to lend. As banks now have less money available for lending, this reduces the total money supply in the economy. Because money is being pulled out, inflation also tends to come down. On the other hand, what if RBI reduces the CRR from 4% to 2%? Now, banks have to keep only 2 crore rupees with RBI. This means banks have 98 crore rupees available to lend instead of the earlier 96 crore rupees. Because banks have more money available, lending increases and more money flows into the economy. This can increase inflation, but it also boosts spending, demand, and economic growth. This clearly shows that by adjusting the CRR, RBI can manage inflation and economic growth and achieve its monetary policy objectives. Next is Statutory Liquidity Ratio (SLR). We have already covered SLR in great detail in our earlier banking video. Here, we will just briefly revise it in an easy way. SLR works very similar to CRR, but there's one important difference. In SLR, banks don't keep money with RBI, they keep it with themselves as reserves. Let us take a simple example to understand this. Imagine a bank has a total deposits of 100 crore rupees. If RBI sets the SLR at 18%, the bank has to keep 18 crore rupees aside with itself. The bank cannot use this money to give loans. So out of 100 crore, it now has only 82 crore rupees available to lend to people. For simplicity, we will ignore other details for now. Let us quickly look at two situations. First, suppose RBI reduces the SLR from 18% to 16%. Now, banks have to keep only 16 crore rupees instead of 18 crore. This means banks now have 84 crore rupees available to lend instead of the earlier 82 crore. More money available means banks can lend more. So the overall money supply increases. While this boosts demand and economic growth, it can also cause inflation. Now let us see the opposite case. Suppose RBI increases SLR from 18% to 20%. Now banks must keep 20 crore rupees as reserves. This means they have only 80 crore rupees left to lend. With less money available for lending, the money supply reduces. This can help control inflation and stabilize prices. So just like CRR, RBI uses SLR as another tool to manage inflation and economic growth by controlling how much money banks can lend. The next important tool is repo rate. In fact, the repo rate is often considered RBI's main monetary policy tool. It is also called the policy rate. But what exactly is repo rate? Repurchasing options, repo, simply means RBI injecting money or liquidity into the banking system. In simple terms, repo rate is the interest rate at which banks borrow money from RBI for short periods of time. Let us understand clearly through an example. Suppose RBI sets the repo rate at 6%. It means if a bank wants to borrow money from RBI, it has to pay interest rate at the rate of 6% per year. Let us see two simple scenarios now. First scenario, if RBI reduces the repo rate from 6% to 5%, borrowing from RBI becomes cheaper for banks. Since banks are paying less interest, they can borrow more easily and at lower cost. So banks can lend more money to people and businesses at lower interest rates. More loans means more money supply in the economy. This can boost economic activity and growth, but it may also increase inflation because more money is flowing into the market. Second scenario, suppose RBI increases the repo rate from 6% to 7%. Now borrowing becomes costlier for banks. Since banks have to pay higher interest, they borrow less from RBI. As a result, banks also increase their lending rates. This makes loans costlier for people and businesses, reducing the total money supply. With less money in circulation, inflation starts coming down. Thus, by adjusting repo rate, RBI carefully controls how much money flows into the economy, managing inflation and supporting growth according to its monetary policy goals. Now let us discuss the reverse repo rate, another important tool in RBI's monetary policy toolkit. In simple terms, the reverse repo rate is the interest rate at which the RBI borrows money from commercial banks. This means banks can park their surplus funds with the RBI and earn interest on them. It is essentially the opposite of the repo rate, where banks borrow from the RBI. But why would banks want to park their excess money with the RBI? The primary reason is safety. Lending to the RBI is risk free compared to lending to individuals or businesses, where there is always a chance of default. By depositing their surplus funds with the RBI, banks ensure that their money is secure and also earn a guaranteed return in the form of interest at the reverse repo rate. Let us understand this with an example. Suppose the RBI sets the reverse repo rate at 4%. This means that if a bank deposits 100 crore rupees of its surplus funds with the RBI, it will earn an interest of 4% per annum on that amount. Now consider two scenarios. RBI increases the reverse repo rate from 4% to 5%. With a higher interest rate, parking funds with the RBI becomes more attractive for banks. They are likely to deposit more of their surplus funds with the RBI to earn the higher return. This reduces the amount of money banks have available to lend to the public, leading to a decrease in money supply in the economy. With less money circulating, inflationary pressures may ease. The second scenario, RBI decreases the reverse repo rate from 4% to 3%. Now, the interest earned by banks on funds parked with the RBI is lower. Banks might find it less appealing to keep their surplus funds with the RBI and may choose to lend more to individuals and businesses instead. This increases the money supply in the economy, potentially boosting spending and investment, but it could also lead to higher inflation if too much money chases too few goods. In essence, by adjusting reverse repo rate, RBI influences how much money banks are willing to lend versus how much money they prefer to keep with the central bank. This in turn helps RBI manage liquidity in the economy, control inflation, and support economic growth as part of its monetary policy objectives. The next tool RBI uses is Open Market Operations (OMO). RBI started regularly using OMOs after the economic reforms of 1991. But what exactly is OMO? Open market operations simply mean RBI buying or selling government securities from banks and financial institutions. RBI does this openly in the financial market. How does it work? Let us understand clearly. If RBI feels there is too much money in the economy causing inflation, it sells government bonds to banks. Banks buy these bonds and their money goes to RBI. This reduces the extra money available with banks and thus money supply decreases, helping control inflation. On the other hand, if there is too little money and the economy is slowing down, RBI buys bonds from banks. Banks receive money from RBI, increasing their funds. Now banks have more money to lend, increasing the money supply. This boosts economic activity and growth. In short, by using open market operations, RBI effectively manages the money supply, controlling inflation and promoting stable economic growth. Next is Marginal Standing Facility (MSF). RBI introduced MSF in 2011. Simply put, MSF helps banks borrow emergency funds overnight from RBI when they urgently need cash. Let us understand MSF clearly using an example. Imagine a bank suddenly faces a shortage of cash late in the day, and regular borrowing options such as repo rate are not available. Through MSF, the bank can borrow money overnight from RBI, but at a slightly higher interest rate than the regular repo rate. Suppose the normal repo rate is 6%, the MSF rate might be 6.25% or slightly higher. Banks can borrow under MSF up to a fixed limit by giving government securities as collateral. Now, two quick scenarios. If RBI reduces MSF from 6.25% to 6%, banks find emergency borrowing cheaper. Banks might feel more comfortable lending money to customers because emergency funds are more accessible. This slightly increases money flow in the economy. Second scenario, if RBI raises MSF from 6.25% to 6.5%, borrowing in an emergency becomes more expensive for banks. banks become cautious and reduce lending slightly, decreasing money flow. This helps control inflation. Now you might wonder how MSF is different from the repo rate. Repo rate is for regular borrowing, where banks borrow money from RBI at a normal interest rate. But MSF is specifically for emergencies, when banks urgently need funds overnight. Because of this emergency nature, MSF is always set slightly higher than the repo rate, making banks borrow under MSF only when absolutely necessary. Thus, by adjusting MSF, RBI influences short-term liquidity, managing inflation and keeping the banking system stable. Now let us move on to the next tool called bank rate. Bank rate is the interest rate at which RBI lends money to commercial banks for longer periods without requiring any collateral. This is different from repo rate and MSF. While repo and MSF are short-term borrowings, usually overnight, and involving collateral, bank rate is for longer-term lending and without any collateral. Usually, the bank rate is kept slightly higher than the repo rate. For example, if repo rate is 6.25%, bank rate could be around 7.25%. Because it's higher and meant for long-term lending, banks rarely use it in daily operations. Repo rate remains RBI's main short-term borrowing rate, and bank rate serves more as a benchmark influencing long-term lending rates in the economy. That is all about quantitative tools. Let us now explore the qualitative tools used by the RBI to manage credit in the economy. Unlike quantitative tools that control the overall money supply, qualitative tools direct how and where credit is used. The first qualitative tool is margin requirements. Margin requirements refer to the portion of a loan amount that a borrower must finance themselves when purchasing an asset, with the remainder covered by the bank loan. It is kind of down payment. By adjusting margin requirements, the RBI can influence the amount of credit available for specific purposes. For examples, suppose an individual wants to buy a house valued at 1 crore rupees. If the RBI sets the margin requirement at 20%, the buyer needs to pay 20 lakh rupees from their own funds and the bank can lend the remaining 80 lakh rupees. If the RBI increases the margin requirement on house buying to 30%, the buyer must now pay 30 lakh rupees as down payment, reducing the bank's loan to 70 lakh rupees. This higher margin requirement can dampen excessive borrowing and help control inflation in the housing market. Next qualitative tool is consumer credit control. In simple terms, consumer credit control means RBI sets rules on loans given to consumers to buy items like cars, TVs, mobiles, and other consumer goods. By changing these rules, RBI can influence how easily people borrow and spend money. Let us see an example. Banks often give loan to buy high-end TVs or laptops. If RBI finds too many loans are given easily, causing prices to rise fast, it can reduce the maximum EMI period. For instance, if earlier the maximum EMI period for electronic goods was 24 months, RBI might reduce this to 12 months. Shorter EMI repayment means higher monthly installments, making people think twice before taking these loans, thus controlling excessive spending. You might think consumer credit control sounds similar to margin requirements, but they are slightly different. Margin requirements specifically decide how much of their own money borrowers must put as down payment when taking a loan for certain assets like houses or stocks. But consumer credit control includes broader rules, like changing EMI durations or conditions, specifically aimed at controlling borrowing for consumer goods such as cars, TVs, or appliances. In short, RBI uses consumer credit control to manage how easily consumers borrow and spend, influencing demand and prices in specific sectors of the economy. Another qualitative tool used by the RBI is credit rationing. In simple terms, credit rationing means RBI sets a limit on the amount of loans banks can give, either overall or to specific sectors. This helps ensure that credit is distributed in a way that supports economic stability. For example, imagine there is a risk of housing market bubble because too many loans are going into real estate. RBI can set a cap, say 500 crore rupees, beyond which banks cannot lend to the housing sector. This control helps prevent excessive lending that could lead to economic instability. By using credit rationing, RBI directs funds to priority areas and curbs lending in sectors that might pose risks to the economy. Next qualitative tool is moral suasion. Moral suasion refers to the RBI persuading or advising banks to follow its policy directives rather than enforcing rules through formal regulations. It's a way for the RBI to influence banking practices using requests or recommendations. For example, in 2009, the RBI observed that banks were heavily investing in mutual funds instead of lending to businesses and individuals. To address this, the RBI used moral suasion by advising banks to reduce their investments in mutual funds and focus more on direct lending to support economic growth. This approach relied on persuasion rather than imposing strict regulations. The last qualitative tool used by the RBI is direct action. This involves the RBI taking corrective measures against banks that do not comply with its guidelines or operate in ways that could harm economic stability. For instance, if a bank persistently violates RBI's lending norms or engages in risky financial practices, the RBI may impose penalties, restrict its operations, or in extreme cases, revoke its banking license. These actions ensure that banks adhere to regulatory standards, maintaining trust and stability in the financial system. This is all about monetary policy of India. Follow our playlist and subscribe to our channel Clarity of Concept UPSC for all UPSC related videos. Visit our website clarityofconcept.com for details and updates. Join our Telegram channel Clarity of Concept UPSC.